So it happened. The US government has imposed reciprocal tariffs on 180 countries, set at 50% of what those nations charge on American goods. In this discussion, I will attempt to explain what tariffs are, the intentions behind their implementation, and the reactions from economists regarding this decision. Additionally, I will explore the potential outcomes, what we can expect if things go in our favor, and what might happen if they do not. Tariffs are essentially taxes imposed by a government on imported goods. Unlike the base selling price determined by the exporting country, tariffs represent an additional cost levied by the importing nation. To illustrate, let's say China manufactures a gadget and wants to sell it in the US for $10. If the US imposes a 10% tariff on Chinese imports, that gadget will now cost $11 in the US market. Importantly, this extra $1 is not retained by the Chinese manufacturer. It is collected by the US government and paid by the importer of the goods. Governments implement tariffs for several key reasons. 1. A protection of domestic industries. If imported goods are priced too low, they can saturate the market, making it difficult for local businesses to compete. Tariffs help level the playing field by increasing the cost of foreign products. 2. Prevention of dumping. Some countries engage in dumping, a practice where products are sold at artificially low prices, sometimes even below production costs, to dominate a market. Tariffs act as a deterrent against such unfair trade practices. So, with reciprocal tariffs in place, the U.S. will now impose 50% of the tariff rate that other countries charge on American products when we export to them. Many countries slap high tariffs on U.S. goods, but when they export their products to America, they face much lower tariffs, or sometimes none at all. This is seen as unfair. So now, under this new policy, if a country charges, say, 30% on American goods, the U.S. will respond by charging 15%. For now, it could increase in the future on their goods when they enter our market. This move is aimed at leveling the playing field and protecting American industries. So you may ask, why didn't earlier governments think it was unfair? Well, I would assume previous U.S. administrations did recognize the imbalance in tariffs, but they often chose diplomacy and trade agreements over confrontation. They might have believed that higher tariffs could lead to trade wars, hurting American exporters, raising prices for U.S. consumers, and damaging international relations. Now, why is the Trump administration doing this? The main intention is to push America towards self-reliance in manufacturing. By making imported goods more expensive through tariffs, the goal is to encourage companies to produce locally instead of depending on other countries. This shift is expected to boost domestic economic activity, create more American jobs, and in the long run, contribute to GDP growth. Besides, Trump argues that the current tariff structure is simply unfair, and this move is about balancing the scales. Of course, there may be other political angles to this, but I'll leave that part out. Let's break this down with a real-world example. Take Apple. It's an American company, but it manufactures iPhones in China and imports them back to the US. Now, let's say an iPhone costs $800. With a 50% tariff, the new cost rises to $1,000. Now, Apple has two choices. Option 1, pass the cost to consumers. iPhones become more expensive, inflation goes up, and everyday people feel the pinch. Option 2, absorb the costs themselves. That means lower profit margins, potential stock price drops, and again, the public loses, this time through the markets. And this is exactly what the government wants, to push companies like Apple to start manufacturing in the US. But in the short term, either way, it's the consumer or investor who feels the heat. Now let's take a foreign company like BMW. BMW manufactures its cars in Germany and exports them to the US. With the new tariffs, their cars will get more expensive. So BMW has two options. 1, pass the cost to consumers. That makes German cars pricier and American buyers feel the pinch. 2, absorb the cost. That hits BMW's profits and may hurt the German auto industry. With fewer affordable foreign options, US car makers may take advantage and raise their own prices, knowing customers have limited choices. This could even lead to unfair pricing practices, at least in the short term, until more domestic or alternative players step in. So again, the short-term impact might hurt consumers before the long-term benefits kick in. Now, you might wonder, if tariffs could lead to high inflation in the short term, why go ahead with them? Well, there's a reason. The US government is reportedly planning income tax cuts, and with tariffs potentially generating $700 billion to $1 trillion annually, the idea seems to be to offset consumer pain with tax relief. In theory, you pay more at the store but also save more on taxes. But here's the challenge. Inflation hits everyone, regardless of income. However, tax cuts aren't equal for all. Lower and middle income groups might spend more due to rising prices, but save less through tax cuts, making it harder for them to break even. So while the plan might look balanced on paper, in reality the impact could be uneven. There's another problem with this whole tariff approach. If tariffs push up prices across the board, that means inflation rises. And if inflation goes up, the Federal Reserve might delay or cancel the interest rate cuts that were expected in 2025. Now, why does that matter? Because the stock market is banking on those rate cuts. Lower interest rates mean cheaper borrowing, higher spending, and better stock valuations. But if inflation stays high, the Fed will hold back, and that could be bad news for the markets. So let's quickly break down what people are saying about this bold tariff move, both in favor and against it. Supporters say this could be a turning point for American manufacturing. If importing becomes expensive, it might finally make sense for companies to bring production back home. That means more self-reliance, more jobs, and maybe even a healthier trade balance. But those against it say setting up manufacturing in the US isn't a quick fix. It can take years, billions in investment, and a skilled workforce. And even then, will US-made goods be cost-effective? Many countries don't have minimum wage laws or strict labor regulations, so it's still far cheaper to make products overseas. Plus, with automation and AI, even if factories come back, the number of jobs created might fall short of expectations. They also fear retaliatory tariffs because this is where it really gets messy. Other countries are already responding. China has just imposed a 34% tariff on US goods and tightened its grip on exporting rare earth elements crucial for American tech. Canada hit back with a 25% tariff on American cars. Macron of France has suspended any investment in the US. The European Union has condemned the move and hinted at consequences. Even allies like Japan and Australia have expressed strong disapproval. Another thing critics have pointed out is that picking a fight with the entire world at once isn't a great idea. If anything, a country-specific tariff approach would have been a better choice. Now let's talk about the big fish, the mighty US dollar. Could this tariff war hurt it? Well, potentially yes. If global trade slows down due to retaliatory tariffs and supply chain disruptions, demand for the US dollar in international transactions could dip. On top of that, if US exports become less competitive and other countries start settling trade in non-dollar currencies to bypass tariffs, it could slowly chip away at the dollar's dominance. And if inflation rises while growth slows, that's a double whammy. So what's the best case scenario here for the US and the rest of the world? Ideally, this bold move by the US becomes a wake-up call. It forces countries to come back to the negotiation table and acknowledge the long-standing imbalances in global trade. If that happens, we could actually see a global de-escalation of tariffs, where instead of raising duties, nations agree to lower them across the board. This would create a fairer playing field, boost international cooperation. In that scenario, the US might not see a massive factory boom, but it could still invest smartly in strategic industries like semiconductors, clean energy, and defense tech, areas where self-reliance really matters. Instead of trying to bring all manufacturing back, the focus could shift to high-value, innovation-driven sectors, where the US has a competitive edge. With all that said, here's a word to traders. Now is not the time to be adventurous. We are potentially dealing with something the scale of which hasn't been seen in our history.